You know, there was a time when most people got a similar send-off when their careers came to an end. But just as many retirement traditions have changed, so has retirement itself. And for a variety of reasons, Americans have been redefining what retirement looks like in this modern age. The question becomes, what will your retirement look like? And will you be ready to meet its demands and challenges? It's time once again to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. Hello, I'm David Scranton. You know, while many people still have fairly conventional retirements, increasingly more Americans in their 60s and 70s are walking a different path in their post-working years, whether it's by choice or by financial necessity. As it turns out, many people are redefining what it means to be retired. Some are rejecting rounds of golf and ocean cruises in favor of new jobs, in favor of volunteering, traveling the country in an RV, or living in a tiny house. If you have a less traditional retirement in mind, you should be aware of the challenges and opportunities that you might face. We're going to address some of those on today's show with the help of our guests, Professor Jamie Hopkins and author Alan Roth. First, let's take a look at how and why this face of retirement is changing for so many of us baby boomers. There's a new normal emerging among Americans at or near retirement age. No longer are most people leaving their jobs at 65 and quietly riding off into the sunset. Instead, many are starting new jobs, writing books, or devoting themselves entirely to lifelong passions like hiking, biking, or camping. Others are taking a cue from people like President Jimmy Carter, who's devoted the brunt of his retirement years to humanitarian causes and social programs, those things about which he is extremely passionate. This shift to a more active, focused, and, for many people, meaningful form of retirement has been verified by groups such as AARP. Their recent research points to older Americans swapping out the traditional notion of retirement for what is better described as a new stage of life. There are a number of forces behind this shift. Some are positive, and yes, some are negative. So let's examine the good ones, the positive ones first. One, obviously, is that life expectancies have increased and healthcare has improved. That means that many people feel physically and mentally prepared to continue working and or remain active far longer than in the past. A recent Gallup poll found that 8 out of 10 American workers believe they'll continue working either full or part-time after they reach what's normally considered to be standard retirement age. And nearly 40% of them said it was because they want to, not because they have to. Many people say they're committed to staying active or employed in their 60s and 70s in order to avoid boredom or outright depression and to help maintain their mental health. And there are many opportunities for older Americans to continue working if that is their goal. You know, the job market has slowly grown. The number of older workers filling openings has exceeded that of younger workers. According to the Bureau of Labor Statistics, even as their population numbers have increased in recent years, the number of people aged 22 to 34 in the workplace has actually remained the same. But at the same time, the number of retirement age workers has grown by 9%. Last year, according to the Labor Bureau, 32% of Americans aged 65 to 69 were employed, and that number is only expected to rise another 4% within the next 6 years. Another key factor behind this shift is generational. The group at and approaching retirement age is, of course, you and me, this massive income generation group, aka the baby boomers. You know, another recent Gallup poll revealed that the hard-charging work ethic and drive that define our generation make it difficult for many boomers to envision downshifting into this slower pace of traditional retirement. Yet, for all the positive forces driving this trend toward a new normal for retirees, there are some negative forces as well. The shift for many Americans is less a matter of desire than of necessity. The same two factors that compel many people to want to work longer, rising life expectancies and improved health care, also force some to keep working. Why? Because they're afraid of outliving their retirement income. Things like low participation rates in employer-sponsored 401k plans and a lack of financial literacy. These types of things leave many people financially unprepared for retirement, period. And we'll talk about that a lot more and how to improve that situation just a little bit later in today's show. But another negative financial force behind the retirement shift is the fact that many boomers have never fully recovered from the financial crisis and the Great Recession. Scores of Americans, including some nearing retirement age, lost much of their savings when the housing bubble burst and the stock market plunged by nearly 60%, 60 from 2007 to 2009. And as we discussed on last week's show, many baby boomers are part of the sandwich generation, which means that in addition to their own needs and goals, they're providing some level of financial support to either aging parents and or grown children. For them, working in the retirement years is seen as more of a necessity than a choice. Why? Because they can't afford the slightest decrease to their current income. Now, regardless of whether it's by choice or necessity, Americans are, yes, increasingly shifting toward retirements that include employment, that are more active, are more adventurous, and often more frugal than conventional retirements of the past. Coming up, we're going to take a closer look at some of the specific new choices that people are making today. And now it's time to welcome our first guest, Jamie P. Hopkins. Jamie is a professor at the American College and director of the New York Life Center for Retirement Income. He's been named a top 40 financial services professional under the age of 40. I guess that makes it 40 squared for those professor types. And he is the author of the book Rewirement, Rewiring the Way You Think About Retirement. Jamie, welcome to the show.
Yeah, thank you very much for having me on today.
So, it's funny because it's like my book. My book's called Return on Principle, and I spell principle ending in P-L-E, and people accuse me of not being able to spell. So I took one look at your book. My first reaction was, oh, they spelled the word wrong. And then I realized it was on purpose. So why did you choose that word retirement for the book?
Yeah, so actually, it's funny. I've had a couple people send me that and say you misspelled retirement right at the beginning, and
I
then
bet.
if you take a look and you see, if you read the book, you get it. But really, the kind of word and title kind of came to me around that a lot of people actually understand some basics of financial planning, and they learn how to pay their mortgages and credit cards and save over time. But once you get to retirement, everything kind of gets flipped on its head, and you really do have to change the way that you think. That average returns, they may not be as important anymore. Cash flow really becomes king. And there's a lot of changes that people just haven't lived through before. So I thought that was a really important kind of theme for this book and really why I wanted to write it.
So you mentioned something there. It's a topic that's near and dear to my own heart. So I'm going to ask you the question, but remember, you're talking to our audience, members of the income generation. You're not teaching a class. So try in as simple terms as possible to qualify why you made the statement that average return isn't as important anymore once you're retired.
Yeah, and this is something you said, take it down to other people when I'm not teaching a class. It's something we often refer to sequence of returns risk. Now, what that really means is once you're spending money in retirement, if you get really bad market years, investment years early on, we get 2008 again, and people remember that. If that occurs early in your retirement, what happens is you spend down your assets faster than somebody who gets good returns early in retirement and bad returns at the end. And that concept really doesn't bother us too much while we're saving, but it's a huge deal when we're actually spending assets in retirement.
Yeah, and what I like to talk about, and you're welcome to use this in your classes, but only if you give me credit for it, is I call it reverse dollar cost averaging when people are taking withdrawals every month from, let's say, a mutual fund. Because everybody knows that dollar cost averaging is a good thing, even though they may not understand why. They've had it drilled in their heads for so long. 401ks, put money in every single pay period. If you put the same amount in, you're dollar cost averaging, which for our audience, of course, is simply buying more shares in the months the market's down and buying fewer shares in the months the market's up. So you're getting your average cost down. And of course, investing is simple, not easy. Buy low, sell high, right? So dollar cost averaging helps you buy low. The problem is once you retire, the opposite is true. Now you have to sell twice as many shares in the times when the market's down, which means now you're getting your average sales price and you're pushing it down. And that makes the cannibalization of the principal that much faster. But Jamie, do you see, and if so, tell us why people have sometimes a tough time making that paradigm shift from looking to average returns or maybe looking from being more aggressive to more conservative. Why do you think it's difficult for people?
Yeah, I mean, it's difficult because we teach you, right, and to save that way forever, right? You spend the whole working career thinking about, okay, I need to look for good average returns, dollar cost averaging, saving, not spending down principal. Then all of a sudden, right, as I said, you get to retirement, all of a sudden you're pooling money out of this. You're selling stocks and selling and buying, right? We know that those are, while there's somebody always doing that on both sides of the transaction, who the seller is and who the buyer is, they're looking at much different things. And when you're in retirement, you need to make income to get by on every week, right? When the stock market tanks, it's almost like losing your job. And that's actually how I often talk about it to people. It's like losing your job. So when your job goes down or you lost some income, how do you get through that time period? Are you going to cut expenses? Are you going to generate income safely from somewhere else? And that's where we start getting a little bit more conservative sometimes with our investments in retirement.
Those are great questions. And if people actually sat and thought about what would I do if the income stopped, you know, I think that might help. We can take a commercial break. We'll be right back in a minute. Stay with us, Jamie. And you stay with us, too. We have more from Jamie Hopkins on the income generation. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Now, if you're a baby boomer, a member of the income generation, you probably remember the truck driving and the CB craze of the 1970s. Well, believe it or not, some boomers are reliving this as a retirement option. In fact, according to a recent study, there's an increasing number of adults over the age of 60 that are getting their commercial driver's license and becoming paid long-haul truck drivers. That even includes some couples who take their training and tests together. In some cases, the choice is driven by financial need. But even for those people, truck driving is seen as a more stimulating option than staying at their old job. But you know, in addition to that, it also satisfies the desire that many retirees have to travel. In fact, nomadic, should we say, retirements of all sorts are increasing in popularity compared to the old notion of having a retirement home in a set location. You may recall earlier this year that we did an entire show on retiring small, in which we discussed the tiny house trend. Many people like the option. Why? Because tiny houses are transportable. According to industry estimates, as much as 40% of the market for tiny homes is actually made up of people age 50 and over. That percentage is expected to grow as more boomers enter retirement age looking for less conventional and or more affordable retirement options. And for those who want or need to continue working, truck driving isn't the only trend gaining steam. In fact, according to ARP, many retirers are deciding to pack their belongings into RVs and join the growing number of older Americans traveling the country in search of seasonal work. The movement's already prompting new terminology, with some referring to these work groups as work campers or the camper force. More history-minded pundits have labeled them as the Okies of the Great Recession, despite the fact that they come from all over and that some are doing it more as a matter of choice than necessity. But either way, they're helping meet the demand for seasonal work in an increasingly fragmented, temp-driven marketplace. Now, unlike the Okies, these work campers aren't necessarily filling jobs like fruit picking, for example. Often they're in an office or warehouse where extra help is actually needed temporarily during a busy season. So how did this whole trend begin? Well, in the mid-2000s, Amazon was often scrambling to find temporary workers during their peak months before Christmas. Then in 2008, a staffing agency came up with the idea of inviting migrant RVers to work at the company's facility in Coffeyville, Kansas. The following year, Amazon brought in more RVers and expanded the program to warehouses in Kentucky and Nevada. In fact, it was Amazon themselves that actually coined the term camper force. Many of the workers involved were around traditional retirement age, give or take, with some even in their 80s. And since it began, Camper Force has helped Amazon fill thousands of seasonal warehouse positions, and many other companies have taken advantage of the Camper Force movement also. Workers in this movement look for job opportunities on websites such as Workers on Wheels. They travel the country pursuing these jobs while sightseeing and staying overnight in RV parks. Again, many are there out of necessity. But there are others that have chosen this option. Why? Because they're in good health and they want to continue working to a certain degree during their retirement years, but also doing it while living a more adventurous lifestyle that includes travel. Plus, it helps increase their odds of maintaining a savings that they can pass on or use for a health emergency down the road. And we'll talk about that also a lot more later on in the show. But another smaller but similar trend along these lines is that of retirees basically living, and in some cases working aboard cruise ships. This sounds like not too bad of an idea for yours truly. Their strategy is to book cruises one after the other over a period of years and just keep traveling. Some have found the cost comparable to that of a higher-end retirement home. But in this case, their homes are maintenance-free. Plus, in many cases, they have access to all different choices in terms of dining, in terms of entertainment and activity, much as they would if they lived in a major city. But the difference is every day is an adventure. Of course, not everyone craves or wants quite that much adventure, but even they are putting a new face on contemporary retirement. Some, for instance, are opting for shared housing arrangements as a way of not only cutting costs, but maintaining close social ties. Rather than conventional retirement communities, they're opting for roommate arrangements, similar to those common with people in their 20s who are typically on tight budgets. Others are choosing niche retirement communities where they can pursue a particular passion, be it art, dance, golf, or anything else, and at the same time be able to socialize with others who share that passion. And, as we already noted, some are devoting themselves entirely to volunteering for causes and organizations about which they feel extremely strong. In many cases, this is not only something that satisfies an emotional need, but also helps them financially. Why? Because their volunteer work is done in exchange for room and board. Again, it's all part of this, what we call this new normal. Now it's time to welcome back Jamie P. Hopkins, author of the book, Rewirement. So, sorry to cut you off a little quickly there, but you know, what you're saying, I always talk to people about, you know, if people sit there for a second and if they honestly try to decide, okay, if the stock market drops, I can't take income this year because I don't want to be selling more shares than I need to, then what am I really going to do? Am I going to live on a lot less income? Am I going to be willing to spend principal and maybe my money won't last as long? Am I going to go back to work? What am I going to do? And I find that psychologically, sometimes if you get people to sit and think about that, they a lot of times realize that none of those choices is very appetizing. And they then realize, okay, it's time to make the shift. But my question for you is really simple. When it comes to risk alone, why do you think it's so hard today for people to make that shift to lower their risk as they get closer to retirement? I mean, psychologically, what do you think's causing that? Part of it, you're right, is maybe all the training we've given them during their working years, so some of it's probably our fault. But what else mentally, emotionally, you think that's happening?
Yeah, I mean, there are a couple things that are happening there. So a lot of people don't want to de-risk until they actually feel the pain, right? So a lot of times what we see is, right, you're okay being risky until when? Until the market goes down. But then as soon as you feel that pain, you overreact to it. And it's at that time that that loss aversion kicks in and you say, you know what, we've got to de-risk now. Well, then we're doing exactly what we don't want you to do, right? Which we went back to before,
Right.
which was now you're selling low, right?
Mhm.
Because you're overreacting. Now, as you said, if we actually get somebody to sit down and say, what's your income going to be in retirement? What happens when the market drops? What are these other risks you face? What are you spending? And we actually take the time to look at that. All of a sudden, you realize,
Yeah.
okay, maybe we do have to make some changes to make sure that we have that stable amount of income for us throughout retirement. And that's what most people want. Most people want, right? Stable income so they can meet their expenses. They don't want to become a burden on someone else. They don't want to lose their assets. But it's, as you said, it's very hard to actually get people to do that planning and get them over that hump. And some of that is because people like seeing their accounts grow. I can't
Yeah.
tell you how many people I've talked to that say, I like seeing that dollar amount in my account, right? I don't want to spend it down. I like that it's been going up for years now
Sure.
in a 401k. And they check it and they look at it and
It
they
feels
care
good.
about it.
It feels good. Yeah,
Yeah,
it really does.
it feels good. It feels like you've done something successful financially.
Hmm.
The same thing's true often with housing, right? That people like buying that house, and a lot of people live in houses that are really too big for them, too expensive for them in retirement, but that felt good to them,
It's
right?
an
They
emotion,
made a
yes.
good decision.
Well, we all make emotional decisions and justify them rationally, right? So my emotional decision is I want you to stick around for one more segment, and now I'm going to justify it rationally during the commercial break. Stay with us. We'll be right back on the Income Generation. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. I'm David Scranton, and you've been watching The Income Generation. As I mentioned earlier, one of the driving forces behind more active, adventuresome retirements is that people are living longer. And thanks to better health care and good lifestyle choices, many are remaining very mentally and physically fit well into their retirement years. In fact, many of the alternative retirement options we discussed in our last segment actually require fitness and good health. The good news is that studies show the more active and engaged you remain in retirement, the more likely you are to stay healthy. A study by the National Bureau of Economics, for example, found that those in full retirement experienced a 5 to 16% increase in difficulties associated with mobility and daily activities. It also led a 5 to 6% increase in various illnesses and a 6 to 9% decline in mental health. At the same time, the study found that those who continue to work part-time after retirement and or maintain their social and physical activities fared much, much better. Now, of course, these are just averages, and for many people, leaving behind the demands of a high-stress job for a more relaxed lifestyle can actually have health benefits. In fact, there's one reason so many people who do choose to or need to remain working today make a change. But it's also true that aging invariably increases your odds of suffering a major health event. And regardless of the kind of retirement you choose, if you're not prepared to deal with that event financially, the consequences could be dire. As I pointed out on previous shows, neglecting or underestimating the potential impact of healthcare costs is actually one of the most common mistakes people make with their retirement plans. It becomes even more common in recent years for two reasons. With baby boomers continuing to work later in life and shifting toward the kinds of alternative retirement lifestyles we've discussed, many have become more prone to taking their good health for granted. They have kind of sort of a subconscious belief that they can just keep going and going and going without a hitch. The second reason is simply that, the ever-rising cost of healthcare is something that people don't factor in sufficiently. Many don't realize that healthcare costs increase at a much greater rate than the general rate of inflation. Since 1948, the price of medical care has grown at an average annual rate of 5.3% compared to 3.5% for the actual CPI index overall. Essentially, that means that healthcare and medical costs are doubling every 12 years or so. And here's the potential danger. If a couple in their 60s today isn't aware of it, they might put aside, let's say, $150,000 to $200,000 a year based on current costs to cover the possibility of full-time in-home health care down the road, thinking that $150,000 a year, $200,000 a year will suffice for full-time home health care. But what they don't consider is that by the time they reach their 90s, the cost of full-time in-home health care may have risen to somewhere in the range of $600,000 to $800,000 each and every year. The point is this: regardless of your plans or goals for retirement, a major healthcare event could easily sidetrack these goals if you haven't sufficiently planned for it. It could be a heart attack, a stroke, any kind of disease, or even an accident, which you might be more prone to with a more active retirement lifestyle. The importance of accurately estimating the impact of healthcare costs is one of the main reasons I encourage people to enlist the help of a qualified financial advisor when creating your retirement plan. Ideally, an advisor who specializes in portfolio protection and income generation. An advisor who specializes in these things can help ensure that you're better prepared to deal with these contingencies like a major health event, and also help you achieve your retirement goals, whatever they might be for you. What else can you do to help ensure that that happens? Well, we'll talk about some more things in just a bit. And we're back here on The Income Generation with our new friend, Jamie Hopkins. So, Jamie, what do you think of this? I always say that I think part of the reason that this generation, this baby boomer generation, has a tough time with this concept of risk reduction as they approach retirement, because their earliest paradigms with investing, for the most part, is the stock market of the 80s and 90s, which, as you know, went almost on a straight upward trajectory. And in life, a lot of times, it's our earliest paradigms that shape our experiences. And even though they may not have felt that at the start of this new century, it's hard to break that stock market addiction. I mean, do you think that's any part of why this generation is have a tough time making that paradigm shift toward income when they retire?
Yeah, I think that's a big part of it. So I think there's kind of two pieces there. One, as you mentioned, the stock market in the United States, and it has been phenomenal, right, for a long period of time. As the early 80s, fantastic. And even things like CDs and bonds were giving you 12% in the early 80s. And then people think, okay, well, I should be getting those types of returns through retirement. And as you said, that was ingrained in them at a young age.
Mm-hmm.
The other thing is they actually watched the previous generation kind of go through retirement and be okay. They had pensions, and they had maybe more Social Security income, depending on kind of how you look at that for inflation, and they made it through, and it worked, right? The greatest generation got through. Now you have a group that's saying, well, they did this, and they didn't know anything more about investing than I do. They didn't, and they're not kind of taking that real look that the pensions really are a much different risk system than a 401k, IRAs, and your individual savings. And so I think there's some of that going on too. They watched a group do this successfully, or mostly successfully, but they didn't see them have to make some of the changes that baby boomers are going to have to make, and then next generations will have to make too.
That's an interesting point. It's kind of a false sense of security because they looked at their parents. My parents had $200,000 and they retired fine. course they did. They had a huge pension and so on. So how about men versus women? You talked about people liking to watch the balance sheet go up. And I find that a lot of times men, and I want to see if you see this, but men being more aggressive, right? We're men, we have testosterone. A lot of us played sports when we were in school. And the reason we have a coach is because, we could be ahead by seven touchdowns in the fourth quarter, but we want to get the 8th touchdown. We want to rack up the score, even though it's not conventional wisdom. So do you find that men have a difficult time with that more so than women for that reason, just how we're wired?
Yeah, so we just actually, and within the last year, concluded a research study of about 1,400 Americans around age 55 to 75. And that's one of the things we found again, and that's still true for that group today, is that men invest much more aggressively. They also react more to stock market changes. So drops, increases, they're more reactive. Women tend to, as a group, invest more conservatively and actually react less to stock market changes. We've also seen there that women are a little bit more likely to actually follow advice from an advisor, while men, for fortunate or unfortunate, tend to be their own favorite expert in a lot of these. So they're a little bit less tend to follow the advice of people they're actually paying to get advice from. So there's kind of pluses and minuses on there. We actually think that women should be more aggressive than they are in their investing. They've got a longer time horizon to invest, and they typically have less money saved for retirement. So there are some downsides associated with that. And then how do we get those people who maybe are a little bit too aggressive and too overreactive to market changes? How do we have an advisor, have a plan, have products in place that can kind of keep you from hurting yourself?
So it sounds like you're saying the male ego is part of the problem that we have, and women accuse us of driving around in circles and not asking for direction. So I guess it's no surprise we do that with our investments. But in the few seconds we have left, tell our viewers or income generation members where they can find Rewirement.
Yeah, so Rewirement, easiest place is on Amazon. You can just type in the word Rewirement. The whole book is Rewirement, rewiring the way you think about retirement.
I love it.
Just type in Rewirement and you'll find it.
We need to leave it there for now. Jamie, thank you so much.
Thank you again.
We'll be right back on the Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
So if you're planning or looking forward to remaining active in the workforce well into your retirement years, then good for you. If you're doing it by choice because you love your job or because you want to make a career change in order to satisfy a lifelong wish or goal, again, good for you. On the other hand, if you're planning to continue working or getting another job in your 60s or 70s only because you're afraid of running out of retirement income, well, that may not be quite as good. And I'd like you to be aware that you may have other options, but yes, they all require taking action as soon as possible. First, make sure you've made a paradigm shift in your savings and investment strategies. That is a shift from focusing on portfolio growth to one of focusing on retirement income. Not only will this set your assets up to generate reliable income, it will better protect you against a significant loss should another stock market drop occur, a correction such as those that started in the year 2000 when the technology bubble burst, and again in 2007 with the financial crisis. And if you're a regular viewer, you know that I believe another major correction is not only possible in the next few years, but actually quite likely. according to the lessons of stock market history. In fact, the record levels of market volatility that we've seen since early February of this year are similar to those that preceded those last two major market downturns. Combine that volatility with factors like GDP growth still lagging far behind stock values, fears of a trade war, a flattening yield curve, and a sky-high federal debt, and it's no wonder why some analysts believe the next crash is not only likely, but yes, actually inevitable. Second, make sure your asset allocation also protects you from the potential of spending down principal in order to satisfy income needs, or things like required minimum distributions, healthcare costs, and any other necessary expenses that arise later in life. Third, get your debt under control. Pay off any high interest loans as soon as possible and avoid taking on new debt. In addition to underestimating healthcare costs, carrying too much debt into retirement is another of the most common mistakes that people make with their money who are approaching or in retirement. And finally, make sure that you have a financial plan that lets you maximize your Social Security benefits and minimize your tax burden. And once again, the best way to make sure you're doing that is to create your retirement plan with the help of a qualified financial advisor who specializes in portfolio protection and retirement income. Now it's time to welcome our next guest, Alan Roth. Alan is the author of How a Second Grader Beats Wall Street and founder of Wealth Logic LLC. He also writes personal finance articles for a variety of top publications, including AARP, the magazine, the Wall Street Journal, and Financial Planning magazine. Alan, welcome to the show.
Thank you, David.
Now, I know one of your core beliefs is most investors have the opportunity to double returns long-term by using logic rather than emotions. And it ties to these 10 commandments of yours, such as thou shalt not buy an investment before completely understanding it. But if I get excited about the hype in this investment, I really, really, really want to buy it, how do I keep myself emotionally from not violating that first commandment?
Well, the first thing you have to do is not act immediately. And a warning sign is this is a limited time offer. I'm sorry, the bonus is only good today, David. So the best way to do it is to think about it, let your logic take over, put yourself in the seller's shoes, figure out how they're making money off of you. They're not doing it to be nice. Talk it over with people that you respect that don't always agree with you. Basically get a good understanding of what the investment is. And it's almost impossible to eliminate emotions. What you want to try to do is minimize those emotions.
Minimize those emotions by being vigilant, diligent, research, et cetera. I actually said earlier on the show that to another guest, I said, we all make emotional decisions. We try to justify them rationally. So, how can somebody make sure, even when he gets this preponderance of evidence after the fact to support this decision to buy an investment, do you have any words of wisdom for how they can do a gut check after the fact and say, okay, now this is supporting my decision, am I data mining, in essence, creating a statistic that's not right because it's what I want to hear, or am I not? Any other words of wisdom emotionally, how people can do that to be brutally honest with themselves?
Yeah, typically once we make a decision, confirmation bias comes into play, and we look for articles that support our decision and avoid those that go the other way. So I would say do the opposite. Try to look for articles of where it could go wrong. And if you can't name at least 3 things that can go wrong with an investment, you're not looking at it clearly. You're not using logic.
I like that advice. Look for articles, specifically try to find articles that make the opposite argument. I think that is great advice. And Alan, stay with us if you will. And you stay with us too. We have many more words of wisdom from our new friend, Alan Roth. We'll be right back on The Income Generation. We're back here on The Income Generation with a new friend to The Income Generation, Alan Roth. So Alan, I know one of your other core values, should we say core beliefs, is understanding that, we all have mental models. And sometimes we actually create destructive behaviors that hurt us financially. And we get in this rut and it happens over and over and over again. How do we help protect ourselves from that? Because we all have them in some way, shape, or form, right?
Yeah, again, look for evidence. When I get that irresistible urge to buy Apple after it hits $1 trillion market cap, do some thinking. I'm buying it at its absolute all-time high. Is it really the right time to do it? Oftentimes bad stocks make better investment.
Mm-hmm. But how about destructive behavior like overspending? Okay, let's say people's parents weren't really frugal and they tend to spend a lot, and today with credit cards and everything, it's even easier. So it's your model, after all, psychologists do say everything goes back to our childhood, right? So that's so deep rooted, and the first step to building a net worth is to spend less so you can save. So any words of wisdom as to what people can do if they suffer from something like that, for example, that's that deep rooted?
Yeah, saving is hard. Investing is actually very simple, but saving is hard. And there's a myth that we tend to get our spending habits from our parents, and there's very little correlation there. The best research shows there's a piece of our brain called the insula that causes pain, and some people may have an active insula, and spending money causes pain, so they save. Others have an inactive insula. So the best thing to do there is keep track of everything you spend. Try not to use credit cards, or if you're going to use credit cards, write down what you're spending, etc. It's pretty much like losing weight. It's not an easy thing to do. You've got to work out more. You've got to eat less.
So in the 40 seconds or so we have left, tell our income generation members, what are the most important two psychological transitions that they have to make as they approach retirement?
Well, first of all, just understand that people are looking for your money, and the best way to protect your money and to live better in retirement is simply to minimize those expenses and emotions. Don't buy expensive products, annuities, etc., and maximize the diversification and discipline. If you had the worst timing in the world and you bought a total stock index fund on October 9th of 2007, that was the day the market peaked when real estate couldn't go down, you'd have made 132% return at this point. Do nothing is often the best thing to do.
Yeah, you're right. I think sometimes people overreacting, it's kind of like being on the highway, switching lanes, trying to get ahead, and you get to the toll booth and that guy who passed you is now right on the side of you. So thanks for being with us, Alan. I really appreciate your words of wisdom. I'm sure our viewers too. Thank you. I'd like to thank both of our guests for joining us today for another episode of The Income Generation. Most importantly, I'd like to thank you, our new and returning viewers. As the old saying goes, there are two sides to every coin. And looking at the changing face of retirement in modern America, on one side of the coin, we see this. We see baby boomers who are living longer and remaining physically and mentally fit well into their retirement years. With good health and a strong work ethic, many of them are choosing to stay employed or to pursue new work opportunities in their 60s, 70s, and even beyond, simply because they want to. On the same side of the coin, we see retirees opting for non-traditional lifestyles, living on cruise ships, in RVs, portable tiny houses rather than new homes, or conventional retirement communities. We see them simply trying to make their life simpler, going mobile, volunteering and following lifelong dreams. Again, why? Because they want to. But on the other side of the same coin, we see people working longer, taking on new jobs and downsizing, not necessarily because they want to, but because they feel like they have to. We see people still not fully recovered from the financial crisis or the Great Recession, and worried that their savings not only isn't enough to retire on, but that it might be vulnerable to the next major market crash. And we see people in both of these camps potentially unprepared for the impact of a major health event. In short, we see both a good side and a bad side to the changing face of retirement today. But no matter which side you're looking at or which side you're on, the key to living the kind of retirement you want lies in taking action now. That means taking action geared toward protecting your assets, growing your portfolio organically, and generating reliable income. Thanks for watching. If you're close to retirement or currently retired and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. Where can you do it? Right here with us on the Income Generation. I'm David Scranton, and we'll see you again next week. Thank you. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.